Good morning, we are TNH, and today we initiate our coverage for Vibra stock with a buy recommendation, with target price of R$24.64, representing a 36% upside and a 21% IRR.
With over 36 million cubic meters sold annually, a wide network of more than 8,000 gas stations and 9,000 B2B clients, Vibra stands as the only distributor with operations across all Brazilian states. Its prominent position and robust infrastructure highlights its current origins as a subsidiary of Petrobras. Now a private company since 2021, Vibra has undergone a strategic rebranding, leveraging its strong cash flow to transform into a multi-energy platform. The fuel distribution industry is highly competitive, making efficiency a critical driver. In this context, competitive sourcing of fuel molecules is essential to maintain market relevance. While recent years represent significant challenges for major players, like the rise of white flag stations, which are independent fuel retailers, we see the outlook for incumbents as promising.
And the optimistic perspective appears to be undervalued by the market. Vibra is currently trading at 6.3 times its forward earnings, near its all-time low. Such valuation levels seem inconsistent with the company's improved standing. Therefore, we issue a buy recommendation for Vibra, based on three key pillars that we believe the market has underappreciated. First, ongoing changes in the sector which are expected to favor larger players, positioning Vibra to sustain high profitability over the long term. Second, illegality combat and Vibra's value proposition that should support white flag station conversion. And third, Vibra at the forefront of energy transition, driven by a robust strategy focused on rapid portfolio diversification and commercial integration.
In our first pillar, we highlight the main inflection points that could reshape the entire Brazilian fuel distribution sector. But first, a quick history review. Before 2016, Petrobras often sold fuel below international prices. However, access to this discounted fuel was restricted to companies capable of maintaining high volumes over time. This barrier limited the market entry for smaller players, consolidating the large incumbents. In 2016, Petrobras has changed, adopting the international price parity model, eliminating the price advantages. But Petrobras delays in price updates have created upcharge opportunities. Smaller players could import fuel at lower costs, bypassing Petrobras and eroding the return on invested capital of the dominant players. Despite these historical challenges, we now see the positive outlook for the sector, driven by three key developments. One of them is the new sourcing dynamics. Since 2022, Petrobras has replaced its strict international parity model with a more flexible pricing strategy, adopting prices below global benchmarks. With that, the advantage in supply has been restated for the incumbent players, and Vibra, as largest Petrobras quota holder, stands significantly to benefit from these changes. Also, distributors are less dependent on Petrobras. Companies have developed their own fuel import operations as a way to import fuels. With that, even if Petrobras changes its pricing model, Vibra is well positioned to benefit from this. Vibra is well positioned. Its strong customer base allows for better demand predictability, and its extensive distribution network in the Northeast region grants cost-efficient logistic advantages. Finally, we also see rationalization in the sector. Since privatization, Vibra has changed its priorities from market share to extent to profitability changes. With that, since privatization, Vibra has changed its focus from market share gains to profitability. With that, evidence of this is the divestment from less profitable stations and acquisition of high traffic locations, as shown by a Google Maps analysis.
This rationalization move, despite increasing margins, has had a negative consequence, a decrease in asset turnover, so Vibra now faces a dilemma on how to increase volumes without sacrificing profitability. For that, we believe the answer lies in the upcoming years of illegality combat, driving volumes back to branded stations, a trend for which Vibra is well suited to take advantage from. The Brazilian fuel market has long faced illegal practice. However, recent actions by authorities are expected to drive a more equitable market, and oversight and corporation, such as the ICL initiative, are fostering a more favorable environment, with significant results in fiscal regulation expected soon. The changes are already being made by taxing fuel at a fixed rate, which results in less price evasion and a level playing field for Vibra. By analyzing the price gap between major players and white flags, we observed already a significant reduction in this disparity since the single-phase taxation started. And once ethanol is included by 2027, this will make Vibra less competition with competing less with artificially lower prices. But Vibra will only be able to capture this available volume because of the unparalleled logistic advantages. Because of government investments, this logistic position allows them to have the lowest distances from refineries to storage and stations, allowing them to have lower costs and lower delivery times, enabling them to convert the best white flag stations to their brand.
But Vibra value proposition doesn't end the logistic advantage. The company had developed new value growth avenues, including the sale of premium gasoline, the presence of convenience stores, and also the brand power that the pricing power that the brand gives, enable the resellers to charge a premium of the gasoline sold and Vibra increase its margins. However, the market seems to underappreciate Vibra's advantage, project a lower growth and margins. This is evident when analyze the future value added project in the stock price that implies a growth of only 2.8% at the cost ROIC. Also, our reverse ETF analysis show that the market price are much lower gross margin for the next year. Now, look forward, we see that the company has an uncertain outlook with the ongoing energy transition. We believe that the distribution business is a dying business, as becoming evident that fossil fuel consumption will decline due to the fight against global warming. As a consequence, we will need to leverage strong cash generation to invest in hedging strategies. The first one was investment in Comerc. Comerc is Brazil's largest solar energy producer. So we decided to study the Comerc acquisition to answer two questions. First, how does the acquisition protect Vibra against environment risk? And secondly, how the acquisition impacts Vibra's fair value.
After analyzing Comerc's assets, we conclude that yes, the company holds strategic value. Its plants are located in regions that mitigate curtailment risks while maintaining access to key consumer markets in Brazil. Moreover, conditions for commissioning new plants in Brazil have worsened considerably, making it even more challenging to replicate Comerc's assets. However, such quality requires a higher price. When assessing the deal's financial conditions, it was observed it was acquired at a higher multiple than its comparable peers. Despite this, we see that Vibra has clear opportunities to capitalize on its acquisition, especially by the renegotiating Comerc debt and unlocking synergies with the acquired business. In summary, we do not believe the transaction was flawless, but in current prices, we do see an opportunity. Adjusting our EPS to reflect only the fuel distribution core business of Vibra, we see that even if Comerc's valuation significantly underperforms what we expect, we still see a significant discount relative to historical levels for the core Vibra's business, reiterating our conviction in the undervaluation of the stock. With that in mind, what are the management's next priorities? Analyzing the management's goals, we see that the company focus has been on pursuing greater growth and profitability, which have been successfully achieved. Moreover, despite operating in an industry with high ESG risks, we view the investments in renewable energy positively. In our opinion, the clear commitment of the management for energy transition positions Vibra better than its peers, as reflected in our proprietary ESG ranking.
But how does it all translate into numbers? We based our forecast on the pillars of our recommendation and summarized them on financial impacts on several key holders. Our analysis of the fuel distribution industry and Vibra's competitive position leads us to believe on the potential of expanding market share at high sustainable margins, providing an equity value of 3.9 reais per share. Also, in a more in-depth look at the numbers, we expect a CAGR of 2.1%, stemming from the recovery of market share, especially in the auto cycle of retail network, accompanied by the gross margin per cubic meter growing close with inflation, following a lower relative molecule cost, higher exposure to more profitable clients, and lessened price competition. We developed a blended valuation approach, incorporating a free cash flow to equity DCF as the main component, complemented by a DTM analysis due to Vibra's strong cash flow and consistent history of dividend payments. We also developed a relative valuation based on the company's historical PE discount, weighted by the discount observed in national peers. Even with conservative assumptions, we stressed our model to account for different events that could harm Vibra's value, in which current industry margins become unsustainable because of changing sourcing dynamics or market share underperforms, those being the most sensitive assumptions in our analysis.
In addressing the most significant risks of our recommendation, we believe that changes in Petrobras policies from current standards or a faster than expected energy transition away from fossil fuels are the most impactful. However, we believe they are unlikely to be this position for hedging against the decline of fossil fuels with current investments and their competitive advantages in the sourcing of fuel molecules. Therefore, we reiterate our by recommendation based on our three pillars, because Vibra is being in a sector due to its offer high competitive advantage to the major players, a trend of combating illegality for the future years, and this Vibra's leadership position in the energy transition. Thank you for your attention. We're open to questions.
Thank you for your presentation. Slide 16, you have the credibility of the BR brand. Have you consider in your analysis if the rebranding is going to have some impact in this pricing power? Yes, we did. Could you go to slide in the risk section? I think it's the next part.
It is the 61.
Oh, 61. Okay.
61.
Slide 61, please. Well, actually, we see that the brand power is really important for branded stations. Therefore, their volume depends on the pricing power depends a lot if the brand is powerful. We saw how the rebranding process will be, and we saw that Petrobras has to advise at least 2 years before of the end of the contracts if they are willing to renovate or not, which will give Vibra about 9 years until the complete rebranding of all gas stations. We think this gives a lot of time for the rebranding process to be done, but we also sensibilized what would happen in our valuation if the company lost its pricing powers. So if there was a reduction in all of the premium that the branded stations could pay, we see that it would imply in a 10.6% percentage points fall in the upside.
You have a buy recommendation, you have like a 30% upside or so. So I would expect your forecast to be above consensus, but they're below consensus. Why is not everyone buying this stock? Since apparently consensus is probably even more aggressive or optimistic than you are.
Well, we believe that the market consensus are higher, sell side consensus are higher than the current stock, our target price, because they are not up to date to current changes in on market risk factors such as the interest rates and which could impact the risk cost of capital and the future projections of their interest payments. But we believe that our buy recommendation is feasible because we are very positive on the gain of combating illegality, which could increase, which would make the current margins more structurally viable, while Vibra increases its market share to increase its profitability and return on invested capital.
Everyone that's coming here is saying that they're going to gain share because the informalities kind of go away little by little. What if things go wrong? Could the big three continue to lose share and now your thesis just won't work?
Yeah. So we develop a scenario to evaluate this possibility. So if it could go please to
45.
So we sensitize for the Vibra is experiencing a drop in market share in recent years. So we sensitize for this continued drop from next years. So in a scenario that Vibra cannot sustain growth on market share with higher margins, and we see still a margin of safety. So if the trend in declining market share persists throughout the end of our projections, we still see margin of safety of 25% upside.
In order to complement my colleague, we believe that the increasing market share is a key part of the thesis, but the current dynamics on sourcing, apart from illegality combat, can make Vibra a more competitive player against white flag stations as it was in the past. So it can at least maintain its market share even if illegality combat doesn't pan out as we hope.
And also, if I can complement, the illegality combat has a consequence not only the gain market share, but also the gain in EBITDA margin. That in our evaluation has impact of much more of the gain margin. So that's why even if the declining market share, if the margins continue to increase, the Vibra can have an upside.
Can you explain a little bit better how Petrobras' pricing policy affects both Vibra and the other players?
Great. So now Petrobras pricing power restores the advantage to incumbents. It currently places at a lower price than the international markets, as we see. But we recognize that there is a risk of the international credit price coming back. So we did an analysis that we analyzed historical data from before the IPP was introduced. So after IPP was introduced, there was a 10% decline in ROIC, and we replicated the conditions that would imply the same drop in ROIC in our model. So from 2027 onwards, we implied this 10% decline, and we still see a margin of safety in our upside. So we are pretty confident that even if this risk happens, our outcome is positive. And besides that, we don't believe that would be the actual scenario. As today, Vibras has developed its important instances, so it can leverage on these opportunities also.
You brought a lot of dynamics that I think that are already quite known, and the stock hasn't kind of reflected any of it. And we are actually seeing some risks, maybe in the near term, that could even pressure the thesis even further because of macro, essentially. So my question is, what would make the stock rate in your view, and what it like in the short term, maybe next year, would make someone want to buy this name?
Well, I think mainly there's a lot of talk about the things you pointed out about Petrobras pricing policy and illegal practices already in conversations, but we believe there's still developments ahead. One possible trigger that we see that on the side of illegality combat is the CBOI's laws that recently was signed that begins a stricter enforcement, and which would lead a higher percentage of players to not evade the purchase of CBOs, which would decrease the illegal advantages. So this is one thing that we expect to happen in the coming year. Another thing is the potential for the advancement of the ethanol being brought in to the single phase taxation, which could be an additional upside to bring this gain in market share for the future.
And finally, we also see Comerc with huge synergies that the market still don't know how to specify. We think that the main analysts of Vibra Business doesn't know how to evaluate Comerc at all. So main of this proportion that is already specified of Comerc is what Comerc has proved that it can do. So unlocking the synergies and proving that the acquisition was a huge move in Vibra's history would change the market's opinion.
But just like adding those, you have like 9.3%, which is below CDI. Why would I buy this name for 9%, given that you have also risks?
Because it's an addition in our upside that's already 39%, so it would be almost 50% of the upside.
Okay.
And also, if you analyze Comerc, Vibra suffered the rating of the Comerc acquisition. And I think that the synergies being unlocked would re-rate the market perception about the Vibra, and that would be a trigger, not on the upside, but the perception.
Perfect.
I have a question on the perpetuity growth rate of 1.5%. Is it in real terms or nominal terms?
This is perpetuity in nominal terms, in real terms. In real terms, because we were originally going to do a 2% growth in perpetuity, but we elected to go a lower growth rate of 1.5% to reflect the energy transition trend that's going to happen especially for the long future, where Vibra's and valuing the Vibra's distribution business at a high growth rate wouldn't be feasible.
In your cash flow statement, your capex is below D&A. Is that sustainable?
We think that it's sustainable because our capex is mainly from the branding gas station. So Vibra, we are not projecting Vibra opening new storages, only branding, and that's why the capex is lower than the depreciation.
Routine philosophy, and in a world powered by fuels and facing energy transition, we see Vibra as a key to the future. That's why we issue a buy recommendation with a 23.8 target price and 40% upside based on four main pillars. First, Vibra's capability to utilize its top-tier infrastructure in order to affirm its leadership position. Second, a shift in the competition towards balance between volume and prices. Third, an unrecognized market share potential. And last, an excellent capital allocation towards ESG investments. Vibra business consists in buying fuels from producers and selling it to gas stations and large corporate clients, acting as a key player in the fuel distribution chain.
Which brings us to our first thesis, unmatched infrastructure. Vibra was founded as a subsidiary of Petrobras in the 1970s, but now as a corporation, it is able to leverage its Petrobras legacy into one-of-a-kind positioning in this sector. The main example we see in this is our tanking analysis. Through Python, we were able to estimate freight costs for Vibra to be up to 14% lower than its peer Ipiranga, driven by its tanking storage, which has a deeper operational reach and also short coverage distances. Also, changing framework, when we look at jet fuel, Vibra is able to leverage in its pipeline exclusivity, high tanking capacities, as well as high Petrobras quotas to be not only the one that charges premium prices in jet fuel, but also to be the main player in this segment, fueling 6 out of 10 aircrafts flying over Brazil. But our third analysis is about highways. We were able in our software to estimate how much gas stations were located in the main highways in Brazil. And through this, we were able to conclude that Vibra not only is the leader in number of highways in 60% of the cases, but also has a broad reach and range in this category. But besides infrastructure, what drives value for Vibra? We can talk about the brand BR Distribuidora, which is owned by Petrobras, and drives confidence not only for the final consumer, but also for the gas station owner. And Vibra has the highest, the most longevous period of clients, up to 11 years compared to 8 years from Ipiranga and Shell. But looking at all of those advantages, do we believe Vibra is able to translate them into a top one-of-a-kind position? Do we believe Vibra is able to translate them into a sustainable business? Not as the 2019 government control company, but as the corporation we see today. Vibra has embarked in an intelligence price volume dynamic, driving a new profile for profitability in the company that shaked the whole sector actually.
And this brings us to our second thesis, a change in the competitive scenario, enabling a better balance between price and volume. In the third quarter of 2022, we saw Vibra improving spreads to the producer prices, following the internal change due to the total exit of Petrobras. In this case, Vibra grew up its margins in both segments. Not only this, the company had already started an optimization process after the privatization, which, combined with this product margin improvement, had growing these margins to be the sector leader. Looking to the entire market, we can see that spreads going up in line with changing Vibra's policies. And looking to retail, we see EBITDA per gas station growing up in the last years, showing efficiency. But a consequences happened. Market share was down. And we look to the gas stations owners, and the gas stations owners for Vibra had a marginal profitability below that the market average. So this make the loss of market share in the last years. But we already see this market share going back.
This takes us to our third thesis, underrepresented potential for market recovery. We believe the market is underperceiving Vibra's potential to recover lost market share due to the volume drop down in recent years. So, why we believe now is a good time for market share retrieval? First, tax evasion is a major issue to the industry and enables irrational pricing application for white flag retailers. To estimate the last 6 years' impact, we calculated tax deficits, and we observed that after 2020, they have been going down due to recent new regulations implemented, and we expected a new movement coming for ethanol due to the new application of the maturity legislation over it that could bring Vibra's volume down for the following years. Now, looking to another framework, diesel, since the end of the PPI priority policy, we saw that not only import windows have been shorter, but they have also continued happening and boosting market share for white flag retailers. But now we see a clear difference. Vibra has been able to balance both spread and prices with import diesel, Russian, and overall countries. That enables a retrieval market share even during import window times, as has been happening since first quarter 2024. And looking at the consolidation of small distributors, we see as good factor for Vibra, such as bringing more pricing rationality to the market, enabling more combat and fights against white flag retailers.
These three factors lead us to disagree with market consensus. This is also seen in Comerc, with a strong free cash flow and ROIC. But first, what is Comerc? Then we go to our fourth pillar, Vibra's excellent capital allocation towards ESG solutions, and Comerc is a translation of that, as it is a company that operates in energy solutions. And to fully capture this, we did a valuation especially for Comerc and saw a 9 cents increase per stock due divergent from market consensus. This puts Vibra in a leading position when we look in our proprietary ESG index. Then, for the future, we see Vibra complying with its CBIO's retirement regulations, but in a market more fair.
How do we translate our thesis in numbers? Given the Petrobras current policies price, we model product by product, volume, price, and costs to estimate our revenue. And for market share, we see a growth for the next 5 years, reaching in a revenue who growth at CAGR of 80%. For the other assumptions, we estimate maintenance of efficient and margins going up after 5 years to recover market share.
Taking all of those assumptions, we reach a 23.8 reais price target based on a blended valuation, taking into account a free cash flow to the equity, a relative valuation, and also a sum of the parts. Looking at the relative valuation, we take 6 times EV to EBITDA for Vibra standalone and a 7.8 EV to EBITDA for Comerc. But for free cash flow to the equity, we reach a total 26 billion for both companies together.
Looking to our main risks, we highlight 2 of them. Vibra being able to balance both spread with market share and a higher competitiveness in pricing. Not only that, we estimate and sensitivity 3 of our main key operational assumptions that go around volume, pricing, and Comerc to create both a bull and a bear case. Not only that, we look at our main macro and valuation variables, and due to its low
predictability ratio, we are comfortable to reiterate our buy recommendation of Vibra based on a top-gear infrastructure, a successful profitability-driven business model, underpriced potential for market share recovery, and an efficient capital allocation towards ESG investments. Thank you.
If I could start, something caught my attention was your sales CAGR of almost 8% going forward. I wanted to understand a little bit better on what drives that. It seems to me that maybe the strong market share gain on ethanol could be one. And if that's the case, I would want to know why would that happen, like this major gain specifically on that product. Thank you.
All right. At the first, yes, the answer is market share. But the thing is, we see 5 years to recover market share, and after this, we going up with the profitability again. So when we consolidated and reached the revenue after these 5 years, we reach a revenue that grow with profitability and volume because of the gain in the competition.
Now, looking through ethanol, we do see that due to its non-monophasic taxation, it suffers from extreme tax evasion. But this is something that will change in the future, as legislation was already approved. So we took that into consideration in our valuation and estimate a gain of market share for Vibra as the smaller players and, for example, White Flags starts losing its major position due to the tax evasion. And we also sensibilized that and saw a 37% increase in ethanol volume.
But just to understand, how did you get to this amount of market share gain? Did you look at gasoline as a proxy? Because it doesn't seem that happened there when they implemented the single phase.
Yeah, the case was most looking comparing with gasoline, but looking to the entire market. So we stressed scenarios and take a little part of market share, for example, to Raízen, and a lot of part of market share to Vibra, and we estimate again total of 24% with the fight against White Flag.
And just adding on it, we also see this gain in ethanol not only being driven by tax evasion, but with biofuels being more used and relevant towards a sustainability matter, especially here in Brazil.
And I'm sorry, just a last follow-up. In your assessment to understand the potential to go to the incumbents, you erased White Flags, or they continue to exist?
So we are taking diminishing White Flags volume, as we have observed for the last quarters of the past year. We see White Flags losing both gasoline and already ethanol market share. So we proportion that growth, but into our stressful scenarios, we took minus 0.2% of growth per year, taking share from White Flag retailers.
Yeah.
Perfect, thank you.
In your DCF, I believe you have an assumption of your perpetuity growth to be 4% in nominal terms. What is the rationale behind that?
The perpetuity for Vibra?
Yeah, for Vibra it's 4%, for Comerica is also 4%.
I could say that we took a approach by real growth in perpetuity, and our estimates are totally based on a 4% stabilization in inflation for the long term. So that's for us a 0% real growth.
Okay, and can you discuss your gross margin assumption in the next 3-4 years?
So what we are assuming here is that Vibra has already raised spreads too much. So we see a slight improvement for the next few years and a stabilization to only inflation improvement until 2034. So these improvements go until 2026, and then we just grow up with inflation as market stabilizes and competition with ethanol legislation, diesel imports tend to be stable on our projections.
Slide 21, you start your consensus, your analysis on EBITDA below consensus. And then 2026, it goes over. I want to understand what's the main driver for this, and also what's the main difference in 2028 when you don't see this valley.
Well, in the past years, we saw Vibra improving its spreads and improving profitability. And because of this, they lost a lot of market share. We believe that now it's the moment to recover this market share. So we disagree with the market, and for us, Vibra will pass through a moment that they will focus on gain market share, and with the fight against white flag and the consolidation of the sector, and after this they will going up this profitability again.
If I may, we also saw marginal profit per gallon liter of the Vibra diesel of Vibra owner to be smaller since third quarter 23 than the average of the market. So the Vibra average owner retail station has gained a marginal profit over the gallon liter less than the average market. So we think that Vibra will reverberate this equation to balance companies' argumentation on market share improvement.
And it explains also 2028?
Yeah, the idea isn't something like you will do in 1 or 2 years. Will be like 5 years to get this market share back. You know, a lot of gas stations switch to other brand, and we project again for 5 years.
Yeah, so for 2024 to 2026, we grow small growth margins for it, and then we go shortly by 2026 when ethanol legislation goes through, and I think it's the best moment for a company to retrieve ethanol market share.
You have a 40% upside. What is missing for the stock to go up and reach your target?
Well, I think that currently the market overreacts in terms of loss in profitability. I mean, consensus expectations upon EBITDA per cubic meter 25E are really high. But as long as we see further results, especially 25E EOD, that's when we are end of year actually, we think that the new story of Vibra getting a higher return on invested capital, but with a different input in terms of volume and margin to be more accepted by the market. And we could say even macro triggers are really good for the company, even though we do not believe it's a macro story.
Hello? I'm sorry, I didn't understand the last part. You said that the macro story is good?
No. I mean, equities in Brazil are not in the best shape, right? So we think that it's a story that goes beyond Bavons. You don't need to buy Bavons to get this return. You can get much higher by buying Vibra, but the story is, I think that any equities in the right moment may rally, and I don't know, foreigners may look better at the company, understand the story, and then unlock value that we see.
As a result of the scenario that you're forecasting, free cash flow yield on slide 34, free cash flow yield is falling until 2028 and just rising up from then. Would it not be a better time for us to issue that buy recommendation? How do you see issuing a buy recommendation when the path of the free cash flow yield is on a falling trend?
Well, if I may, we think now it's the time because the market seems to be overly pessimistic of market share expectations, and maybe by 2028, market share will reach what our projections are coming to, so it will be a shorter upside into them.
Vibra, Brazil's leader in fuel distribution, has been underestimated by the market and is offering substantial re-rating potential. Good morning, we're Team 11 from Fundação Getúlio Vargas, and you're initiating coverage of Vibra with a buy recommendation and a 24.6 reais target price. Distributors operate in a highly segmented industry. They rely on Petrobras, the only domestic supply option, and imports, as Brazil is not fuel self-sufficient. After acquiring the products, they carry out all of the needed logistics to deliver to the last stage of the chain, resellers, and other businesses. However, Brazilian distributions face a unique perspective when compared to other nations, given the country's strong reliance on biofuels. Their business sustains less energy transition-related risks.
Founded in the 70s as a state-owned company, Vibra went public in 2017 and now dominates the local fuel distribution sector. Its BR-branded gas station network is the largest in the country, holding a 5% market share advantage over its nearest competitor. Additionally, the company owns Latam, leading lubricant factory, and also operates an extensive franchise system with over 3,000 stores. Our buy recommendation, aiming for a 39% upside, is based on four main pillars. First, a future with better supply conditions. Second, an increase in the fight against illegal players. Third, unmatched logistical capacity. And fourth, an excellent positioning in Brazil's energy transition.
Going ahead to our first pillar, we predict important changes in supply dynamics, and Vibra is very well positioned for them. Due to lower margins, distributors are in a constant race for the cheapest supplier. In this sense, imports has been happening more and has given smaller players access to better prices. However, in our view, this dynamic will change. In addition to price-related factors, we see imports as increasingly risky. Last year, according to our analysis, the average import window was 10 times smaller than the year before, and they were a good deal only 15% of the time. Therefore, given 3 main points, we believe that the domestic source will be the best option for most of the time, and the ability to access it will be essential. Because of Petrobras' quota system and the variables considered, Vibra is the best place to take advantage of this scenario. In all of them, the company has unrivaled leadership. This is translated by our estimate that Vibra holds almost 40% of the quotas. In other words, it has the right to buy 40% of Petrobras' volume destined for the domestic market. This extremely important mode will allow it to buy the lowest prices, while other smaller players will have to resort to more expensive alternatives. These conditions will enable Vibra to present better margins and market share gains, similar to the sector's golden age, when imports were not attractive, incumbents' numbers were much better than today, and multiples were also much more appealing. For that reason, we believe there is significant potential for the company share to be re-rated.
Moving on to our second thesis, we believe that the increased fight against illegality will also generate great opportunities for market share expansion. Recurring legal cases generate huge losses for the market in general, and these cause a huge default for the sector as a whole. Based on a proprietary Python analysis, we mapped all the cases reported nationwide, observing that the ones related to the issue of tax evasion was growing at a rate of 22% annually. More than that, we observed a very successful track record of processes registered in the Brazilian justice that we attribute to a victory for the government. Even more important, these legal actions shows effectiveness in combating illegality and constructing a better competitive environment for the sector. More than that, this leads to enhancement in companies' results, as already expressed in its margin effort growth before and after the monophase law. But it doesn't end there, as we expect much more to come with further adjustments. All these create a pressure to a stock price correction that we estimate will achieve at least R$2. Finally, this unique moment creates great opportunity. Besides being a mature market, the fuel distribution sector here in Brazil represents a condition of fragmentation, with more than a third dominated by minor players that tend to lose competitiveness. We expect so that more than 10% of market share will be recovered by irregular players. But what truly ensures that will be Vibra recovering this market share?
We believe that due to its current logistical capabilities, it holds an undeniable advantage in securing a significant portion of this market consolidation. Representing a third of Brazil's total installed capacity, Vibra can operate in all Brazilian states, maintaining an average distance of 140 kilometers to a white flag fuel station, significantly closer than its peers, which provides a substantial logistical advantage to 1. Dilute cost, and 2. Consolidate market in the whole country. This strategic position provides Vibra with a significant unused capacity, offering great potential to market share growth. We estimate that if Vibra were to operate with the same tank turnover as peers, it could increase its annual volume by 80%. With this advantage, Vibra can grow without additional investments, leading to a higher marginal return on invested capital driven by the volume increase. This positions Vibra to benefit from a reduced competition scenario driven by 1. The decline in legal activities, and 2. Petrobras' new pricing policy. This advantage not only gives Vibra a good path to market consolidation, but also provides fixed cost dilution from its strong logistical network. We estimate that, through operational leverage, there will be an increase of 46% in EBITDA per cubic meter if Vibra were to double its volume, which we believe will provide a margin of 190 EBITDA per cubic meter in 5 years.
Finally, the market is not pricing correctly Vibra's stance in the energy transition. When it comes to the Brazilian energy transition, biofuels lead the way. Electrification has limited feasibility for heavy cargo transportation, but our energy matrix is getting clearer thanks to the adoption of biofuels. With local production, state incentives, and already well-established infrastructure, biofuels have gained traction as an alternative capable of reducing greenhouse gas emissions by up to 80%. Thus, electric cars in Brazil are likely to remain niche, giving distributors like Vibra a favorable outlook. However, the market is underpricing this long-term protection. By analyzing the implicit volume pricing to Vibra shares, we found that the market expects a sharp 3% annual drop in volume sold after 2034. In our view, this is an overestimate, as Brazil's energy transition is heavily reliant on biofuels, which are liquid. Forecasting a more optimistic scenario, a modest inflation growth rate in perpetuity would be more than enough to provide significant upside for the stock, giving the investment a strong margin of safety. With its even in a negative scenario for biofuels, Vibra's diversified portfolio mitigates cash flow risk through its acquisition of Comerc, a solar and wind energy producer. The acquisition provides Vibra with higher cash generation, higher operating margins, and more economic resilience.
Now, to validate our recommendation, we use a free cash flow to equity approach and reach a 24.6 reais target price, an upside reiterated by both our relative and a dividend discount model. Reflecting our catalysts, our DCF was mostly driven by market share gains and margin improvements. We also sensitized our model considering the most pessimistic scenario with a limited 12% downside and a factual, optimistic one with an 84% upside. Going through the key numbers, we forecast Vibra's market share reaching 28% in 2029, reflecting our view that the company is poised to consolidate the market. Looking at margins, we see efficiency gains that provide 190 adjusted EBITDA margin in 5 years. Outlining the key risks to our recommendation, we identify 2 main factors. First, potential changes in supply dynamics that could favor imports, and second, the company's increased leverage because of the acquisition of Comerc. However, we anticipate a future that is dominated by domestic sourcing as well as robust cash generation from Vibra. Given these considerations, we are confident that a company with a strong supply moat, significant expansion potential, market dominance, and a solid margin of safety will mitigate these risks and generate long-term value. Thank you for your attention. We are open to any questions.
Thank you very much for the presentation. I'll start off. You mentioned that sourcing is an important pillar. Can you actually explain how Petrobras quotas are allocated and how protected Vibra is from eventually those quotas changing?
Okay, so the Petrobras quota system is what Petrobras used to allocate the volume to its distributor. This is because Petrobras cannot meet all the country's necessities, and also because it doesn't have any differentiation on price. So the aim of the system is to ensure that the domestic market will be widely served, and for this we consider four variables that are important for Petrobras by deciding each quotas for each distributor. So we know of them like purchase historical volume, because we don't know how much exactly as volume is purchased by the distributors from Petrobras, market share, regional coverage, and also logistics capabilities. Vibra outstands in all of the terms. So it's basically, and just to the second question, we see no incentives from Petrobras to change the system.
On slide 19, you discuss about the non-electrification of the auto manufacturers. How does your view match global auto manufacturers? Because I see global auto manufacturers moving to electric vehicles, and in a way you're saying that we're going to maintain biofuel. How do both strategies match? And do you think they would be willing to develop and manufacture internal combustion engine only to Brazil, while other countries would be moving to electrical vehicles?
Okay, thank you for your question. First, the electrification is not a solution for heavy cargo transportation, which is obviously super important here in Brazil because we have a massive country and we also export a lot of goods through long distances. So all the diesel demand here in Brazil would not be consumed by electrification. But when we go to light vehicles, of course we have a different scenario here in Brazil. Electrification is heavily advancing in China, Europe, and a little bit also in the US. We see China as a specific example, and it's different from Brazil because they have a high state incentive for electric vehicles. And they also have a better infrastructure around the country. Brazil is struggling because we don't have enough medium income to buy electric vehicles. We also don't still have the infrastructure, and our country is super well suited for biofuels because our light vehicle fleet is already hybrid, right? So we are already adapted to it, and environmentally it's a super well suited solution. So that's why we see Brazil in a different position from other countries.
In terms of supply, what's going to be needed for biofuel to offset or bypass traditional fuel and not hurt Vibra's volumes or margins?
So I can answer that one. Basically, what we see is that it really relying on government incentives. So what we are seeing right now with Renovabil and other measures by the government is that more and more these biofuels will gain space in Brazil. Total full distribution of food.
This slide 16, you showed the install capacity. You're using that as an argument that you can grow your volumes without incremental capex. But knowing the history that this was a state-owned company, how do you know that this capacity is actually idle in the right place?
So, sorry, going to the appendix. I will answer while I'm passing. So basically what we see is that, yes, Vibra is is inside all over the country, so it's very capitalized. And what we see is that it has a great proximity to a white fuel station, and that gives some advantages, right? We understand that the Vibra was a state-owned, and that's why really Vibra has this advantage, because if you see the peers, they are really in the east of Brazil, while Vibra can penetrate into another regions and guarantee this new market share that are coming to the sector.
Regarding the timing of the buy, what would actually drive the stock to re-rate in your view? What are the key triggers, thinking about like 2025, that makes you gives you comfort to actually buy today the stock instead of waiting a little bit longer?
Okay, sure. So answering your question, we think that there are three main catalysts. So first, the sector as a whole suffered a lot with the Russian diesel situation, and in based on our analysis, this import window is closing. The spread between Urals and Petrobras pricing is closing. So we do not believe that this scenario that heavily impacted the company would continue. Second, we think that the government is using some strategies to reduce illegality, and we think that it can continue to do so. And if it effectively do so, we have a lot of market share that the company can acquire. And third, we believe that the company is the best positioned in this scenario given its idle capacity.
And also, in terms of the financial projections, you actually forecast that going forward they will grow market share and improve margins. Doesn't that seem a little bit too optimistic? They just did, like, they needed to choose one. Why would they be able to do both so consistently going forward?
So we understand that it's difficult to grow with margins, but in our projections, we only considered a growth of margin with economies of scale. So it comes with the volume that we projected.
And how does that compare to consensus estimates?
Well, we do not have actually the operational margin, but we have the adjusted EBITDA. In our opinion, the first 2 years would not be very positive for the company regarding the market view, but we see from 2027 onwards that our projection of volume would be increasing, would be a more positive scenario for Vibra.
And why do you think it's not aligned? Like, I think you're below consensus, then you're like 10% above. Why there is this mismatch?
We think they were quite conservative in the first 2 years, considering first, as Hanan said, our fixed cost dilution. So after that, in the volume that it can actually increase in our view, that would drive this major EBITDA growth when compared to consensus.
We're in the beginning of 2025, and assuming that Brazilian GDP grows 0 or even decreases 1% this year, do you think that this is a good stock to have, or because since, as you said, it seems cheap, or do you think that there are other options in the Bovespa, better options than Vibra?
Oh, that's a very good question, because historically GDP and diesel consumption or other fuels are very correlated, but we think that there are two major factors that protect Vibra from this risk. The first one is that out of the total market volume cannot grow, we project some market share growth for Vibra, so its volume will grow. And the other is that the agribusiness, that's a very important driver for the sector, have very good prospects for 2025. Like this soy crop the projections are to grow almost 13%.
Imagine like we are in 2027 and the stock is down 50%. Why would you think the stock would go down 50%? What is the largest risk or the biggest risk in your view for Vibra?
Well, we think that the largest risk would be regarding Petrobras pricing policy. As we said before, we do not see any kind of incentive to the company to change it right now, but we do believe that if it will happen, Vibra's volume would take a huge decrease as well as EBITDA margin, since having this type of supply would be very important for the company. So based on our sensitivity analysis, considering the most pessimistic scenario with EBITDA regarding margins and market share would, yes, justify this downside that you mentioned.
Pessoal, boa tarde. 6 meses, né? 6 meses estudando a Vibra, 6 meses ralando, entendendo sobre lubrificante, combustível, posto de gasolina, querosene de aviação. Eu tenho certeza que vocês se esforçaram muito. Vocês viram aí pelo feedback dos graders do relatório de vocês, foram feedbacks fantásticos. E vocês são campeões. Assim, tá todo mundo aqui, são vencedores. Deve colocar nas redes sociais que vocês são finalistas. porque o trabalho de vocês ficou fantástico. Tá? Vocês conseguiram entrar nos detalhes. Eu sei que estava todo mundo claramente nervoso, porque é um dia difícil. Vocês têm 10 minutos para falar tudo aquilo que vocês acumularam nos últimos 6 meses, então é dureza. Mas vocês estão de parabéns e queria pedir uma salva de palmas a vocês. Parabéns! Também quero agradecer aos Fact Advisors. Quem são os factos que estão aqui? Temos Fact Advisors. Nenhum facto, tá ótimo. Pais, namoradas, irmãos, familiares. Parabéns pelo apoio. E vamos lá, gente. É o que mais importa, né? Quero dar só feedback geral. Nos anos anteriores, a gente sempre pedia para vocês falarem mais... Vocês, né, participantes do challenge, falarem mais devagar. A gente viu que nesse ano foi muito bom. A velocidade que vocês falaram diminuiu bem, o que é importante para a gente compreender o que vocês estão falando. Então, vocês estão de parabéns. Tem um ajuste ou outro, mas fantástico. Tá? Um outro feedback geral também que a gente quer dar como judges é a importância da análise proprietária. Tá? Para os anos, quem estiver assistindo aqui em agosto de 2025, em 2026, façam análise proprietária, que é algo muito valioso, e procura destacar isso na apresentação, que é valioso não só na etapa local, como na etapa subregional, regional e assim vai. Então é algo muito legal. Quando vocês estiverem fazendo análise, explore o poder de síntese de vocês. Deixe os pilares, as análises bastante claras e sintéticas para a gente poder entender o que vocês estão falando, porque vocês dominam o tema. E é importante a gente saber o que vocês estão falando, a gente poder escutar o que vocês estão falando, processar e continuar escutando os argumentos, as análises de vocês, que são fantásticas. Uma provocação que a gente faz para vocês. Hoje a gente só teve baia aqui. Existe céu na vida também. Então, quem estiver assistindo em agosto de 2025, em 2026, 27, 28, bota o céu no radar. Claro, o que manda é o valuation, mas, enfim, eventualmente podemos ter céu. E eu vou falar para vocês, o vencedor, a gente vai disponibilizar as gravações daqui a alguns dias. Assistam as apresentações dos seus concorrentes, dos seus pares, para tirar coisa boa, para tirar coisa ruim, para ver o que a gente perguntou para eles e melhorar a apresentação de vocês, para vocês se prepararem para a etapa subregional e a etapa regional. Então vamos lá, pessoal. O que mais importa? Eu vou falar o terceiro colocado, o segundo e o primeiro, que vai avançar para o subregional. Fechado? Então vamos lá, gente. Primeiro, parabéns a todos. E o terceiro colocado é a Universidade de São Carlos. Parabéns, São Carlos. São Carlos, parabéns. Parabéns. Vocês estão de parabéns. Agora o segundo colocado. E aliás, o terceiro, o segundo e o primeiro colocados, depois eu vou pedir para vocês ficarem aqui, que a gente vai tirar foto, tem certificado, tem troféu, enfim. Então fiquem aqui. Segundo colocado, pessoal da UNICAMP. Parabéns, UNICAMP. Parabéns. Acabou, vocês não querem saber quem venceu não, né? Posso ir? Gente, primeiro colocado, parabéns, vai representar o Brasil. Que rufem os tambores. Vai representar o Brasil na etapa internacional. Equipe 11, GV. Parabéns. Pessoal, cada um de vocês estão de parabéns, tá? Todas as equipes, muito orgulho de vocês, assim, vocês dão trabalho pra gente, porque hierarquizar, dar nota pra vocês é a pior coisa que tem. Então, assim, fiquem super orgulhosos, parabéns, vai ter certificado para todo mundo, tá? Eu vou pedir para vocês procurarem a Denise, que faz a super organização aqui, para pegar os certificados. E é o momento de pagar mico. A Nayara também, que ajudou vocês, levanta a mão ali. Nayara, agradeço pela força. A Nádia, que está do lado da Nayara, também é staff da Society. Cadê o Everton, que é nosso diretor executivo. E mais uma vez, agradeço publicamente ao pessoal do BTG, pessoal da Vibra, nossos patrocinadores. Enfim, gente, parabéns. Ótimo trabalho de todo mundo. Peguem os certificados ali com nossa equipe. Ótimo 2025 para vocês. Muito sucesso.
Troféu e certificado.